In today's lesson, we will talk about the deal synergies. Remember that in almost all of the mergers and acquisition transactions, the deal price exceeds the target standalone market value. The target standalone market value is either based on the market capitalization of the target if the target's a public company, or we estimate the standalone market value of the target based on some sort of valuation method such as discounted cash flow or market multiples. The important point to note is that the standalone market value of the target already includes the target's risk profile and expected growth of the cash flows. Therefore, the question arises as to why companies that engage in mergers and acquisitions transactions pay a price to the target's shareholders that exceeds the standalone value of the target. And the answer is synergies. We've already mentioned in our previous lessons that for the deal to create value, the value of synergies has to exceed the premium paid to the target shareholders. The synergies can be hard to achieve and are often the least certain component of M&A analysis. Even if the bidder does not pay any premium to the target's shareholders, achieving synergies can still be difficult. The bidder must squeeze out the value in excess of what is already priced into the target's share price or valuation. The current share price may already price in significant gains and improvements. The price may capture the benefits of current R&D, market development, and marketing. These current expectations still need to be met. One way to demonstrate what may actually go wrong with the acquisition of the target is to break down the post-acquisition earnings per share into pre-acquisition EPS, embedded EPS growth, and acquisitive EPS. The embedded earnings per share growth is what the market expects the target to generate. Failure to meet these expectations will destroy value. And then we've got the acquisitive earnings per share. And this is the earnings per share that will be generated by the combined entity based on operating, tax, and financial synergies. So, even if the market expectations are met with regard to embedded EPS growth, the value can still be destroyed if the bidder fails to realize the projected synergies. We mentioned in the previous lesson that the main reason why companies engage in mergers and acquisitions is synergies. Synergies can be classified as operating synergies, which consist of revenue and cost synergies, and non-operating synergies that include tax and financial benefits that a combined entity can generate. Revenue synergies include product expansion, market expansion, cross-selling, and acquisition of new distribution channels. Cost synergies include economies of scale that result in the reduction of fixed cost per unit of production, reduction in the direct cost of production as a result of the combined two companies, reduction of costs as a result of acquiring better inventory or distribution systems. Increased productivity as a combined entity receives access to a better human capital pool, so increased productivity would result in a decreased operating cost per unit of production. Tax benefits arise out of increased depreciation expense for purposes of taxes. For example, if the transaction is structured as an asset purchase, the combined entity can step up the asset value, which will result in an increased depreciation expense and, therefore, lower tax expense for the combined entity. Almost all M&A transactions give rise to a new intangible asset called goodwill, and when the deal is structured as an asset purchase, the goodwill can also be depreciated for the purpose of taxes, and this will again result in lower tax expense. We will cover the deal structure in more detail later on in the course, and the point to remember is that the deal structures can generate significant tax benefits for the acquirer, and therefore increase the value of the acquisition. When it comes to the financial benefits, one of such benefits is when the target has an unused borrowing capacity. We typically refinance the existing debt of the target in M&A deals, and the refinancing facility may exceed the existing debt being refinanced, and therefore, additional cash flow can be generated by the transaction which can be used to finance the acquisition itself. And lastly, the refinancing can be done on better terms than those of the existing debt, which would result in a lower interest expense. We have reviewed the operating and non-operating synergies, and next, we will review the valuation of those synergies. The synergies are valued on a standalone basis using the discounted cash flow valuation method. The cash flows coming from the synergies are discounted by the weighted average cost of capital of the acquirer. Some market professionals adjust the weighted average cost of capital upwards to account for the increased uncertainty of synergies in M&A transactions. Remember, the increase in revenue or decrease in operating costs happens before tax. Therefore, for the purpose of valuation, we have to convert these pre-tax synergies into after-tax numbers. Synergies can also be valued based on market multiples such as enterprise value to EBIT multiple.